it's Dak Hartsock with ACI Wealth Advisors Process Portfolios with the third quarter and year-to-date update and a quick view on what I expect moving into the end of the year. For those of you that would like to learn a little more about me, you can visit dakhartsock.com/about. Quick summary. Much as we saw at the end of the second quarter, live portfolios are doing reasonably well. 3 of 6 are doing very well in terms of beating their benchmarks, and 2 of them are beating the market. I had some very strong performance in 3 of the portfolios that I'll get into shortly. Quick word about core equity and the exposure to biotech, pharma, and healthcare, and that's that it's continuing to see heightened volatility, which means it's moving up and down a lot, much more than it normally does. And the thing to understand about this is these sectors are causing some problems in the short term within the core equity portfolio, but the earnings are either stable or growing, especially in pharma and healthcare. We're seeing some good earnings. So what that is going to mean is if we do see the earnings strengthen in the broader market, that sets up a potential rally in these sectors. And that's kind of what I'm expecting at this point, as long as the earnings story stays in line about with what I expect. And right now it is make or break for earnings. We're moving into earnings season right now. We're beginning to see the Q3 earnings. Stronger earnings are going to set the table for the market strengthening into year end outside whatever the election does, which is kind of an X factor. At the same time, a fall in earnings is going to do the inverse. It's going to set the table for further selling, and that could actually be exacerbated by the election, depending on some of the things that the candidates say or do before we actually get into November 8th and what happens immediately after. Regardless, right now, if we look at the RPI, that's the Recession Probability indicator, it's still indicating that we're in a phase of economic stability. That's subject to change, of course. But as long as we're in a phase of economic stability, generally investment is rewarded, and it pays to be invested. So here's a quick asset class survey. You can pause the video if you'd like to make sure you get every one of these in your head, but I do want to point out 2 things, as I pointed out previously. Here we've got the 20-year Treasury with an 11% year. Here we have the aggregate bond market with almost a 6% year to date. When you see these kind of numbers out of bonds, something's wrong. And those of you that watch these and pay attention to some of the things I say and write know that I've been watching this for a while, and you probably also know at this point that other managers are fairly concerned about this. So just wanted to point that out. Here we go, live performance. Again, you can pause the video here. I'm just going to kind of set up how this works, and then I'm going to get into the color. This first column is just Q3, how the portfolio did in Q3. And then we've got year-to-date results for the portfolio. And then up here, we've got the benchmarks. So the S&P, this is a mixed stock bond portfolio, and so on. And I'll give more color on these as we move on. But I do want to kind of call out a couple of things here real quick. Core equity, we can see, had a pretty good quarter. It actually did slightly better than the market. That's what it's built to do. Had some difficulties in the first quarter due to the sector exposure that I just talked about a moment ago, and that's really held back the year-to-date results. But it's really, since the first couple of months, has come on very strongly, and I'll show you that in a moment. In either case, it's beating the model, so we're winning at least 1 out of 3, which could be worse. Market income, having a great year so far, about in line with what's expected. Hopefully we'll see it continue. Full cycle, same kind of thing. It's doing about what it's designed to do. Hopefully it will continue to do that through year end. Durable opportunities is a better story than it appears, and I will get into that. But we see it had about an inline quarter with the benchmark, which is the Dow Jones. But again, the story is better than it sounds, so I'll get into that in a moment. Market momentum, pretty strong year so far. I think we're going to see a little more volatility, a little more up and down in October and November as a result of the election. But hopefully we'll see this portfolio finish up with a strong year as well. And it's certainly heading that way at this point. Fixed income, this is model only. There are no live dollars in here, but I want to keep it up so that people are aware that it's something that we're looking at and tracking. And this is the model. So far it's doing fairly well. Going to give it another quarter or 2 before we actually put live dollars in there to make sure we're very confident about what's happening. Okay, here's 2015 and 2016. If you want to just read through that, you can pause the video. And here's core equity. And what we see is it is lagging, as I pointed out earlier, but here's what's important, at least from my perspective, is what we're seeing here is March through September, and the portfolio is actually beating the market, and that's what it's built to do, and that's what it's traditionally done. And it's done so for equivalent or lower risk. So I think that once we get through this election cycle and some of the rhetoric about biotech and pharma and healthcare kind of fades away, that those sectors are going to go back to doing some of the things they've done before, which is to be primarily defensive. And at the same time, I think they have potential to rally. So we may see, and I anticipate at this point, that I don't need to make any changes to this portfolio once we get through this election cycle. And I think it'll just go back to what it's done year in, year out in the past, which is give market-like returns with substantially less risk, or exceed market returns with approximately the same risk as the market. So we'll see how that plays out moving into 2017. Market income doing fairly well. It's beating the benchmark. It's beating the market. It's doing about what it's built to do. That's the blue line here. So pretty strong year. This is the result of taking 30% less risk than buying the market. So this is a risk managed portfolio, and when you effectively manage risk, sometimes you can get some pretty good outcomes, as you see. And for those of you that follow these for a while, it did about the same thing last year. Here's the full cycle. Again, that's the blue line here. These are live accounts. This portfolio takes about 70% less risk than the market itself. And to have these kind of numbers coming out of it while you're taking substantially less risk is kind of nice to see. And it's doing really exactly what it's built to do. It's beating its benchmarks. It's managing its risk. And we're getting some reasonable results out of it for very little risk relative to the market itself. Durable opportunities. I'm going to try to spend maybe a little extra time here. This is the only individual stock portfolio ACI Wealth Advisors and Process Portfolios has, and it seems like we're lagging the benchmark here. That's a little disingenuous because this portfolio is generally between 40 and 50% cash this year. So when you look on what's called a return on invested capital, or the return you got for the dollars that are actually invested in the stocks and not sitting in cash, these numbers are considerably higher. So this, about 6% versus the benchmark at about 7%. If you were to take away that cash and just say, what's our return on the invested capital in this portfolio, it's going to be above what the benchmark was. So the difficulty is we're not getting all the opportunities to buy the stocks we want at the prices we want, and as a result we got a lot of cash sitting around. But even so, it's not a bad outcome. Market momentum's doing fairly well. Like most other portfolios that ACI manages, this takes about 30% less risk than the market itself. We do see periodic bouts of what's called volatility here. That's when it moves up and down a lot. Again, this is the blue line. We're going to see those every quarter, every couple of quarters. I think moving into October, November, we're going to see that again. But regardless, we're seeing some pretty good performance, a little more stability than the market, and just kind of moving its way up. So hopefully we'll see that continue into year end. Certainly that's how it's designed. Fixed income, again, this is primarily the model. I just want to show this chart. This is what was happening. This is why we stopped fixed income. It wasn't behaving the way that it should have behaved. So we've kind of re-engineered this entire portfolio. We don't have any client dollars in it right now. We're just tracking the model, and so far the model's looking good. It's looked good for this year. It's looked good for last year. So we're going to watch it for a couple more quarters, and then we'll decide whether it makes sense to actually put live client dollars into this, or whether we need to find another solution. But so far it's looking very stable and looking like it gives pretty good returns on a relative basis. So current outlook 2016, rising possibility of recession as we've seen for quite some time. No signal yet. Bond markets are featuring higher risks, and I think we're clear on that by now. I think we may be underway in a corrective phase that began a couple of days ago. We'll see. I think maybe it's got some more downside to go before it stabilizes. I'm not sure how far that's going to go. Regardless, as long as we're in an overall stable economic environment, any pullbacks, any corrections are opportunities to get cash to work and should be treated as such. Fed appears like they just want to try to keep everything as smooth as possible, as I've talked about before. Oil prices may soften into year end, but that's a good thing for the consumer, and that's therefore a good thing for earnings in every sector except energy. I think the economy is probably going to strengthen a little bit into the year end. I think we'll see earnings strengthen a little bit. Hopefully, 2 quarters from now, I won't be on here saying I was dead wrong about that. But I think that some of that strengthening could be offset by Brexit effects, as I've said before, especially in the financial sector. And I think the Fed's watching that. So if we do get a rate raise in December, it's not going to be big. Certainly, the economy will be able to withstand whatever raise we get if we do get a raise. But there's a lot of uncertainty out there in Europe and emerging markets, in China, so on and so forth. And because of that, I just don't see the Fed being aggressive with rate raises. I just don't see it happening. So it's going to be lower rates for longer, lower growth for longer. It's probably just the way we're going to have to deal with things for a while until we get another bear market and things wash out. So I think, as I've said before, significant percentage gains are going to come from income and income generating activities, portfolios like market income, portfolios like market momentum, dividends, in the other portfolios, that sort of thing. And as I've said before, I really don't have any idea what's going to come out of this election. It's well, I'll just leave it at that. It's, I think, disappointing to everyone, the choices that we're facing. But it is what it is, so we'll see how it plays out. As always, thank you for your time. If you have questions, please feel free to reach out to me at my email's right here, or you could stop by either aciwealth.com or dackhartsock.com and go to the contact page, leave a message. I'm happy to respond. My clients, of course, all of you have my office number or email, so feel free to reach out if you have any questions. And now I'm going to cue the theme music and let the disclosures play. Thanks very much. Hope you have a great week.